Well, I'm going to the city and I'm gonna do a city show. And I know all my fans wanna learn how to make some dough. I've been cruising up and down for trades each and every night. And with my iPhone exciting, I know we're gonna get it just right. I'll get inside your mind, we'll have a real good time. We're gonna trade today, we gotta trade today. Go askSlim.
Hi, I'm Steve Miller. Call me Slim. And this is the askSlim Market Week. It's a look back at what happened in the financial markets in the past week, and a look forward at what might happen in the next week, and hopefully lots of great ideas and opportunities for you throughout this show. Well, the stock market gained ground again last week, though it really ended up mixed on the week. The nature of the rally is changing as the Nasdaq is weaker, as well as those stay-at-home stocks that drove the market up as this environment changed this year. It's a clear rotation now as investors are buying the beaten-up stocks they see value in and then selling these past leaders. And they're building portfolios in zombie stocks. Really should have a new ETF. They're all about these stocks that should be, well, dead, but being held together by the Fed. And that whole idea of creative destruction, well, that's a phrase that seems to have been made obsolete. It was another week featuring overnight gaps as Monday was a holiday, and by the time they opened up on Tuesday, the S&P 500 was up 60 points overnight. Lots of hope about the economy coming back. It is the environment now where trading has improved as the Nasdaq stocks have had sinking spells. We saw that on Tuesday and Wednesday. And then Thursday, late in the day, the market moved down very sharply on the news that President Trump was going to hold a press conference on Friday talking all about China and the likelihood of some pretty important sanctions coming out. And the president is on a rampage about China and tweeting about it constantly, and Kudlow coming out and saying the U.S. is furious at Beijing over their actions on Hong Kong as they clamp down on that part of China, really what was independent for a long time, now semi-independent, and considered the hub, the financial hub in Asia. So there is fear about what the president might say. Friday, the market did soften, awaiting the president's comments and remembering how the market took big slides to the downside when the trade war was going on and all that information that was coming that seemed quite negative. So we got these big declines. And my best guess is that the president is going to do some maybe limited financial restrictions that maybe won't scare the market all that much. Because he doesn't want to break the market. And he thinks the market is a good measure of how he has done here in the economy and through the COVID crisis. So he's not likely to want to really shake that up very much. That's supposed to be late in the day, and that tougher speech might even come after the close, depending on how tough it's going to be, because of how he feels about the financial markets. So I'm recording this video here now around midday earlier because we don't really know what time that's going to come out. Notable on Friday was the data that came out about the consumer, who has gotten far more conservative. Maybe it's just fear, of course, as spending has crashed. Consumer spending down 13.6%, and the savings rate has soared to a record level. As certainly there is major concern about, well, when are they going to get their jobs back? How long will the government keep giving them money based on this massive unemployment that we're having? Certainly the unemployment, the situation will never be like we saw it again, 3.5%. That's gone in our lifetimes. And it might be that, in about 3 or 5 years, we see 5 or 6% unemployment again. But that's probably the best that we're going to see going forward. And the stock market's got plenty to fret about, which it doesn't seem to be. U.S.-China tensions, of course, the civil unrest over the death of George Floyd, protests around the country and spreading around violently, and very bad economic data we're seeing, and a huge market valuation based on earnings plunging. Yeah, a lot of the stay-at-home type stocks and some of the FANGs, they're benefiting from it. And stocks like Dollar Tree and Dollar General, because people want to be paying less for things, all of that, those stocks doing better. But overall, earnings as a whole are very likely to be falling, and the stock market is extremely overpriced based on those earnings levels. But none of that seems to matter, as investors are focused on 2021. I've heard analysts say that, well, 2020 it didn't really happen. We can just simply ignore it. It's a rip-up, as they say, or we're just going to give the economy a mulligan, that this likely didn't happen, and we get to do a do-over. And of course, no issue with the Fed buying and backstopping everything, and some leaders out there trying to even make it legal for them to buy stocks. Then it would really be everything that they could buy. And just as in 2020, and 2020 is looking very different than we would have ever guessed back in 2019. Well, I think 2021 will look different than investors are expecting it to be now. There's all this talk about the vaccine. Boy, I hope that does happen. We all do. That's really actually very low odds, even with 100 companies out there trying to find one. For coronaviruses, like the flu, there's never been a vaccine, and that's a huge challenge to find it. Let's hope they do, but that's very low odds. The recovery that they see, well, that's very low odds too, because of the huge damage that's happened here in the economy and economies in the world. It's going to be a long time before there is a significant recovery. Yes, there will be a bounce. Everything will look better at some point. But, a lot has to do with the virus and what the second wave looks like. And there is certain areas that it's pumping up again right now. And we talked about this rally and have seen it and talked about the bullish momentum that we have seen and expecting it to go into June. Well, here we are coming into June right now. And we think that starting in 2 or 3 weeks, there is a lot of risk, and that risk is growing. So we say beware the June swoon, which we think will last well into the summer. Stocks, S&P 500, they gain around 1% for the week. The Russell also, but the NASDAQ has some slight losses here at midday on Friday. Bond market slightly down, as that market is just really dead in the water. The 10-year yield's up about 2 basis points to 66 basis points. Gold loses about $8, but really improving after a big decline early in the week and looking much better. I'll show you that in the short-term view. The dollar, bad. Breakdown. It's set up for a big decline into late summer. I think that is going to help those metals markets. And oil trading sideways now in a pretty narrow range. That's the opening of the market. I do want you to go to askSlim.com. Take a look at our memberships there. Are you watching this on YouTube? Give us a thumbs up if you like this video. If you don't, make sure you let us know why. And subscribe to the YouTube channel. Share it. We put out tons every single week. Follow us on Twitter at askSlim. And if you want more information about our memberships, write to Matt at askSlim.com. All right, we're going to dive right into our best and worst stocks for the week. We do cycle analysis, of course, and our cycle analysis is based on rhythms of the market. It's essentially a way to see money flow, and the work that you see on these charts is mostly done manually by me, by Arvi, by our team here, and we have a big team, so want you always to support us and consider subscribing. Let's jump into looking at the 5 best stocks for the week, and we'll take a look here at Macy's. Now, Macy's is a stock that we really have not followed much. Once it broke down under this $5 level, we just pulled it out of our focus list because it just wasn't very tradable. You can see what's going on here. It gains about over 20% on the week, 22%, and they have raised $1.3 billion. So that allows them to have existence for a while longer. Of course, they're in these big box malls that people are not going into, and they're trying to reopen them, and the traffic is going to be horrible. And they do online business, but who wants to order online and then expose yourself by having to go to the post office or somewhere to return it? So there's all of those issues, and that's my fear speaking, of course. That lifted the group is retail and home builders were about the two best groups this week. And their ratings cut by the major rating companies, their debt ratings by S&P and Moody's, and the company still has got huge risk. You can see our cycle analysis in here, and what we were looking for was this modest bounce and then coming back down over here or sometime into the summer. So we think that this rally, which hit that 23%, 23.6 there, is already failing, and there's not a lot of reason to believe that Macy's has much of a great future looking forward. They're going to have to do some major rebuilding and figure out how they can do their business online to be able to survive. Now, the other side of that is Dollar Tree, which people are going to because they want to be able to buy things for a cheaper amount of money. And that's kind of regular household stuff and food and stuff like that. So this is a pattern that is really improved, as you can see that. Earnings were a big beat, really, as the frugal consumer is shopping at those kind of stores, Dollar General, Dollar Tree, and they're buying this low-cost stuff. 19% gain on the week. Fantastic, as you could see that. The target is up here to that 78.6%, around 106. So as you can see, there's still some room in here. These are the cycle patterns that you can see right in here. This is a cycle bracket. It essentially is a guide for us. So you could see the rhythms in the market. You could see the low, it lines up close to here. They don't have to be right on. All they are is close. They're guides. And the next low is out over here, and that's probably going to set up a buy, which is out in August. So again, we're looking for markets to decline in the summertime and set up a lot of buys, and this is one of them. So we're going to expect it might be able to get up to 106, some kind of a peak in here in the next couple weeks, and then pull back. Once we have that peak and anchor point, we'll be putting in the buy zone over here. Much better looking stock than it was. And one of the key things that we often talk about is the 34-week moving average. You can see that in here, the blue line. It often, when the stock or anything gets far away from it, it returns back to it. You can see here where it broke down well below that 34-week moving average and comes crossing it again. I can tell you that this might be a good area or a target here as that comes down right into this area in the mid-80s while this corrects, to be setting up that buy that we're talking about. That is Dollar Tree. Another stock we'll look at in this category of the retail stocks is DKS, which is Dick's. Now, Dick's rallies up to that area that we consider the sell zone between, or upper sell zone, between the 61.8 and the 78.6% fib. And it now is coming into what we consider to be the minor low. So in other words, it gets up here, rallies, and then this minor cycle points to a decline out here into early July, right in there. Another kind of a rally, and then probably a pullback right over here. This points to October for really the buy timing for that stock in Dick's. And you see the major break, it then gets up into the major resistance, and now this is likely a spot for it to pull back. Analysts upgraded this stock this week, and we don't really agree with it. We think that that upgrade is really late and that it's too late, that it might fool around in here somewhere between 35 and 40 for a while, few weeks, but then there is some risk that this stock will be heading back down under the $30 level out into the fall. So we don't love this one. Also in the group, just some favorable mentions. Gap Stores up about 11%. Dillard's up about 10%. Both of those stocks, similar patterns, similarly terrible, and we don't think that there is a lot of hope for any major rally for them. In the home builder category, boy, it's a perfect environment for home builders as we have extremely low interest rates, and we have housing prices really strong. Though sales are on the weak side, prices are strong, and nobody wants to really go out and look at houses right now and expose themselves. So that's the issue. And you can see here, this is another one that gets up into the sell zone, hits the 61.8% right over there, and now pointing for a decline over here. This is now our buy zone under the $27 area. That's quite a ways down, but again, just like we're looking for all stocks to fall between now and this late July, early August, that's really the timing. And that's where we think we're going to get the best buys in that time frame for another period of rebound in the markets in the fall and towards the election time, which probably will be the end of it then, and then the real bear market takes hold. You heard me say that. You've heard me say it before anyway. So you see that in toll, and we think that there is a decline and then a pretty good buy area coming up. KB Home is another example. Both toll and KB get analyst upgrades. You can see in here this gets past the 78.6%. This is unbelievably great. Now, whenever you see these dashed lines in here, this cycle bracket, what was the alignment in here changed, and we recognize those shifts in there, and then you can see how it changes the timing in here. This calls for decline into fall. I'm not anxious to sell this one right here. I'd rather buy it on a dip because it does still look good. And as I said, the environment, despite the fact that, well, people are out of work, it's really a good environment for people to consider buying a house as the costs are really very low with these very low interest rates. I see that mortgage rates now are getting to around, I think the 30 years, about 3.15%. Wow, that's some significant low levels. And I've seen the 15 years down in the mid twos. So, excuse me, got a frog. That the environment is right, and you can see it in the way these stocks are acting. So that is the best for the week, and now we're going to talk about, here comes the worst. In the worst of the week, it's really some special situations, and then gold stocks started to pull back a little bit, but you're going to see they really look like buys. So we're going to switch here as we go from the KB Home stock to Hewlett Packard, HPQ. This is a very bad look here. You can see that when you look at this, you have this engulfing pattern right here this week. Their revenues had a big miss. Stock's about 13% down on the week. The printer business was really getting soft, and they're backing off their buyback program, which, of course, a lot of companies are going to need to do as they run out of money in this very weak economic environment. And they'd be really smart to do that because they're going to have problems getting money from the government if they're doing buybacks. And a lot of these companies, of course, that are really struggling and really need help out of the government, well, government's going to control that for sure on them. So Hewlett Packard, a smart move to pull back on their buybacks, conserve the cash, do it on their own, don't be subject to government oversight. And this is a stock that looks to us like it's going to head back to that $12 or $13 area sometime between now and, yes, early August, as you could see right over there, in synchronicity with many of the other stocks that we look at. So Hewlett Packard, don't like it. It failed getting up near that 34-week moving average. Remember the value of that 34-week moving average as it keeps moving up and down through it. This time, not able to get that high, and we don't think it will in this cycle. Netflix is the next one, NFLX. This was one of the stay-at-home stocks that started to back off pretty significantly. Again, you can see our cycle analysis in there. And what does this call for? Well, like many of the other stocks, a decline into late July or early August right over here. This is your support zone. We think the stock is going to get down under 390, potentially down here to about 370. That will be the time frame and the price. Cycle analysis projects in time and price. To then consider that would be the time to be buying it. You can see these two blue spikes right over here. That's our time frame to be seeing it in those levels and then moving up again. So this stock pulling back because too much money in the stay-at-home stocks, and if they believe the economy is going to recover, then these stocks will not be in favor. Twitter is one that's under fire right now, TWTR. As you can see, it pulls back. We have what's known as a VTL in here. This is a trend line that ties together the important cyclical highs. It backed down before being able to get through it. This is a dark cloud cover. We're looking for the stock to fall. It probably will get down into July around the $27 number. President Trump is at war with this company. Twitter flags one of the tweets recently as glorifying violence and then hid that tweet. And now the president, because of other things that Twitter is coming down on him on, he's signed an executive order for all social media, removing the protections that were there for them for lawsuits. So he is at war with social media right now, and specifically Twitter, and that's what you see going on there right now. We'll switch over and look at some gold stocks. This is really important because gold is firming again. I'm going to show that to you. Look at the cycles that are in here. So what we're looking at are the smaller cycles right there. There's a little bit of a shift. We call that an overlap that went on there, and the low, which came right over here. So here's your low, right? And here's the cycle coming up here. It makes a peak that you can see. It gives you that engulfing pattern right over there. So I'm looking up here while I'm pointing down here. And it comes down. And this looks like it's got maybe another couple weeks. This is the buy zone in here. And I'll tell you, when you have a low here and a high here, and then a low way up over here again, then the odds are better than 70% that you're going to make new highs. That's why we have this listed as a buy zone. This is Barrick Gold. They bought Rand Gold, and this is a big company, and certainly a company that benefits from the leverage. Their earnings will explode if gold goes up any higher. That's why the silver stocks are going crazy also, because silver is the leader. And I'll talk a little bit more about that. So that's GOLD, and we'll look at AU. So GOLD gains 8% on the week. AU gains about 5.5% on the week. There it is, that upper buy zone, the same small cycles that you can see. You can also see a bigger, more dominant cycle that's in there. And now both of them bottoming together and getting ready to move up. And that gives you, there's a minor cycle in gold that's going to be bottoming also and driving it to the upside. All of that says that this zone right over here is a screaming buy. People write to me, what do you mean by screaming? Well, it's an emphasis word. I like it. This is an important zone. That's where I want to buy it, right there. The price level, well, right over here is around 24.10. The bottom of that right over here is around 22 bucks. So 22 to 24, if it dips down in there again in the next couple of weeks, I deem it as a high probability long side entry zone. I'm not recommending it. I am simply sharing with you our analysis. That is really what we do here at askSlim.com, because we want to give you our best analysis and let you then apply it to your own trade planning. Well, think about trade planning when you look at this. What would you like to be doing based on the analysis that you see here? Based on the highest probability? We're really bull-bear agnostic. You hear me be bearish about the stock market because it's a big, long picture, but you see that I'm just following whatever the shorter-term indicators tell me, as I'm doing right in here. It says bullish, and no matter what you think about gold, no matter what you think about the metals, that's all supportive to this, but these patterns say the stock is not likely to get below that support zone and likely to make a new high, as we're projecting up towards the top of that broadening pattern that you see following there. So maybe it gets up to 29.30 from 24. That's not a bad trade, is it? That is a look at the best of the week, at the worst of the week, and AU, which falls 5.5%. You tell me, is this one of the worst of the week, or is this really one of the best? That is what I'm going to show you on that for this week. So now we're going to move into our short-term view for the coming week as we look at the 5 major markets. So what we're going to do now is we're going to switch over, and we're going to go to the daily chart, and we're going to go to the /CL for light crude. I have this set up on I hope I have it set up on 2 year, right? I do. So now I'm just going to come in closer right here. This is really interesting. So for the week, we get about 80% credit. I don't get a lot of credit for CL, but I get a lot more credit for the other markets, which were pretty close to what we thought were going to happen. Now, CL, we were looking for a bigger dip, but there was no dip in here, really. I mean, the market did fall, but not by a whole lot. The peak right over here was up at around 34.75. The decline right over here was only down to about 30 and a half. So that was extremely narrow range, as you can see. Momentum still quite strong in here. This cycle corrective period gets you nothing but sideways action. That's positive. I actually have it drawn to only get back up to this 35.40 area. You have the 89-day moving average coming down over here up into the 37s. So we're going to project it to get over $35 again. When we look at that, we're going to call a range somewhat narrower than or higher than we had it before, where 35.40 being the top of the range for the next couple of weeks. The bottom of the range being at this area here, around 28.25 at that top of that support. And pretty much stuck, we think, in that kind of a range after a big improvement. We had looked for the markets to get nervous back while June was still on. As the May market, we saw that collapse to negative territory. But that didn't really happen, as there was a little better numbers coming out as far as the supply-demand situation, and also the storage situation alleviated a bit, so the market never got nervous again. And we think that that time is going to come a little bit further out there. So the sum of the evidence is that it's still in a range. The odds are pretty high that in about 2 weeks or 3, it will begin to turn down again for a bigger intermediate correction. So the upside, downside right now we see as minimal. However, risks picking up starting in after a couple of weeks. Gold market. This chart in the short term is going to look a little different to our subscribers who get our charts level 3 and level 4 because I updated it this morning. What happened was that this corrective zone, this corrective phase right in here, which is essentially this cycle here, bottomed early. So when you get early bottoms, and you can see that upward turn right over here, it tells you that there's a specific anxiousness by traders. Also, the dollar had a breakdown over here, and the gold trades mostly inversely to the dollar. So that upward turn that we see right in here, and you can see the flattening out. We went to neutral momentum. We could go to positive momentum pretty quickly in here. For the next 2 weeks, you can see we're looking for some upside. We're going to be projecting higher again based on what we're seeing in here. We've been trapped in this range that you can see, and that was an intermediate consolidation going on. And now we think that there's a potential to get out of the range in these next several weeks. We're going to look for up near $1800 again here in the next week, and then potentially they're moving up towards that $1850. So this is a pretty bullish scenario that we're putting in here. And the fact that we got this earlier bottom, we're going to send out some new charts in the next day or so over the weekend with this update in here for our members. And this is a better picture than I had when I showed it in Future Speak, because we were worried about it breaking down below key lows over here, but it didn't. It held, thankfully. And I said, boy, I hope it holds, and it sure did. As you can see, and it's moving to the upside again. Silver, another high, another recovery high. So while here's the high here, and here's where we are in gold, silver's way up here relative to the chart, and it is super strong. And we've been calling for that, and a move to 19. So what we see here, the sum of the evidence, is that the intermediate time frame for the consolidation widened a bit time-wise. And everything still looks the highest odds of moving to the upside. We've got a little flattening in momentum here. The longer term momentums are super strong. And we see that there is big trouble for the dollar, and that's very good for gold and silver. and we're going to be projecting these higher prices that you see, 1800 first, and then a pretty good shot at 1850. The next one I'm going to show you is the dollar. So we just talked about the dollar weakening and breaking down. It's been trading in this right side of this diamond, essentially. You can see the megaphone here, the broadening pattern, and then the narrowing pattern. This is significant. You could see the support right over here, and we have this labeled cycle support low for this cycle, and a breakdown is negative. And here's the breakdown. Here's your VTL, and that VTL gives you a breakdown. You want to learn about VTLs? In our cycle analysis workshop, there are 20 video modules, and I talk about VTLs in there. So that break right in here says that the next rally will hit the resistance right in here and then move down sharply again. So what you can see in here, the timing based on these patterns, is that there's a little low do right over here, and we've got this. If I tighten this up right over here, you could see there's a hammer bottom that formed right in here. So it says that this cycle bottom came. High odds for that. This right over here is around 98.90. We kind of think we're going to get into there, an outside chance here for 99.23. And that says to me that this next, well, close to a few days, maybe a week, we could get this pop up into this area. Could stop at this area under 99 and then turn south again. And this period over here where it turns south is really important for the gold market, because if it does follow this pattern that we believe is happening, it will be very supportive to the price of gold and silver. So just the fact that this breakdown came right over here is a very strong message. Some of the evidence, well, momentum, you can see turning negative in here. And that momentum is saying that rallies will fail, and that we're going to continue to see the market churning its way to the downside with some potential for some very big declines. Now, if this China situation gets really ugly, the safety bid will come in and push it a little higher into this resistance area, but we don't think it really will be enough. And if anything, a calming of that situation will break the dollar even further. So we think the dollar, some of the evidence is that there is a lot of risk, and this decline in here that you could see us forming into a stair-step decline is likely to go out into late summer based on the intermediate pattern. So lots of risk out there, we think, for the dollar, very supportive to the metals markets. Bond market, we're going to be a little repetitive in here and say, it's a ruined market. Look at this thing just move sideways. You can see the slim ribbon laying on top of itself through this whole period right here. There is no momentum. We thought that the market would come down a little bit, but not break below the low, have some upside movement in here. We are barely getting any movement. I almost can't. Let me just grab this right over here to try to blow it up so that you can see there is nothing in here. So momentum is stuck, just nothing there. We expect a minor bias to the upside in here. Again, if China tensions pick up, it will get a safety bid. See that peak that we got there last week at about 79.20. The odds are pretty high it's going to get up there. You can see we're in this rising phase, or we're getting ready to begin it. So that gives you some modest upside, we think, in there. But again, I'm a disappointed guy. I've traded these things since I traded them in the pit back on the board of trade all these decades ago. It was 4 decades ago that I was trading in that pit there. So that's a sad situation where it's become very, very untradeable. So that is a look at the bond market. So now we're going to talk about something different. I'm going to show it to you a little bit different as we look at the short-term view for the stock indexes. I'd like to bring you something that I think is of high value in this analysis, because most of the people that watch this show, and this segment is the segment that is by far the most popular of all the segments. We have well over 10,000 views for this segment on YouTube that you can see in some of them, and just a huge amount of views, and people really want to see it. So I want to, because so many of you are shorter term traders, either swing traders or scalpers, day traders in the market, I want you to see our stock index report, SIR live stream. This is running live right now. And what we have in here is a look at 3 different markets: the S&P 500 that you can see there, the NASDAQ, and the Russell. These are 15-minute charts, and what they have in there is some of the best information you'll ever see. Now, the first thing is directional decisions, and then the next thing is location. So your directional decisions you can get that from the reversal scout, which is this line that you see coming down right over here. Also, decisions that you might make about pairs trades. If you want to be long one and short one, you can get help from that also. You can see this is still moving down here and weak. You can see the NASDAQ turning up a little bit here, but these are not significant changes yet, and the Russell's still weak right over here. The green areas are your support areas. When you break through supports and get into the yellow zones, that's where you get the accelerations. Now, this is kind of a strange day because we really haven't gotten those accelerations. If you look here at Thursday, you can see the beautiful information you got here. As the market rallied and really didn't turn over till late in the day, and then you had that bigger break. So you can see how it followed. Note in here how the Russell turned down sooner than the other ones and gave you a very good indication. And when you get through these yellow zones, they're going to be impulses, and you're going to be able to catch those really big trades. So you get supports, you get resistances, you get the directional movements, and you get a good sense of which ones you want to buy and which ones you want to sell, if you want to buy or sell or do both. Unbelievably fantastic information. We get tons of emails of how this has turned people around as far as being able to trade. The key is to be able to have more winners than losers, for your winners to be bigger than your losers are, and this goes a long way to help you with it. This great information comes out every day just a little bit before the opening, and then you'll have this live chart. Right now you can see this running live. You don't need to have any special platform. We're going to send you a link for this, and this is included in level 2, 3, and 4 membership. So take a look at askSlim.com and you'll be able to see. So right now, what are we looking at? Well, the market's kind of stuck. It's in those white zones that you can see. It's pretty rare. We don't get a lot of days where it gets stuck in the middle, but it also came down into those green support areas and then did start to bounce, as you can see. So if you were short, you would, when you get down to those levels, you would probably consider taking some in, especially when the reversal scout starts to turn upward. Then it gives you a sense for that. So great information that you will get. You're not going to get anything like this anyplace else, as this is custom done every single day with the immense amount of work that goes into this. And credit our COO Matt for this one. He heads up this one. Our technical analyst Arvi heads up our analysis for our trade ideas, which are put out every single day. And of course, I'm the overseer and do all the major analysis. So we all work together to bring you this just amazing stuff. So go to our website. Please do become a level 2, 3, or 4 member to be able to get this every day live. And it will make an immense difference. You apply this information, and you need. We do live events on Tuesdays for our members, and we go over this a lot. So we'll be able to help you with that. Or you can write Matt at askSlim.com, and he'll give you more information about this also if you want it. So you can see there, this is the SIR live stream. This is daily. We also have an SIR daily report that gets sent out through the email, and an SIR stock index report weekly that gives you the much bigger information for longer term holders, swing traders, with all of our charts. Amazing amount of charts that are on there and great information. Level 2, 3, or 4, please do sign up for that. And now we're going to get into looking at those charts for the S&P 500. So we're going to go to SPX. That's where we do this analysis. And there you can see the cycle patterns in there as they essentially are screaming at you. You can see that. Cycle patterns for the daily S&P 500 and the other indexes, they move a lot. And they move between 16 days and 20 days generally. You can see in here this was 19 days. The one before that in the decline here was 16 days. This is 16 days, and we're projecting out to about 18 days. There's minor cycles in there, and you can see the minor cycle here, and then the minor cycle here. Very clear. This one, not clear at all, and pretty annoying because the market was so strong, and you could see the momentum still very strong in here, and all of these buys. If you don't understand what these are, you have to watch our video that talks about my favorite trading pair, the slim ribbon and the projection oscillator, and it gives you fantastic information. You can see in here the strength that it's throwing off right here, and now we're still in this positive pattern that we see in here. Minor supports right at this level, but then we get into a riskier time out over here. The question is, will the market have any kind of a sizable break on this news on China? If it does, we would expect it then to bounce a little bit, but then you get into bigger risk out over here. So we're looking for the next couple of weeks. The pattern is suggestive of trying to trade a little bit higher in here. We don't know. It's a low odds to get up to that 31.43 level. It's a possibility, of course, but that's still a long way up there. And with this pattern turning over at some point, it's going to lower those odds. The odds are very high of a move down over here into the second week of June. And then the potential for a lot of risk out over here as we get later in June. We've talked about that is where the risk turns gets much higher. So some of the evidence, in our opinion, in here is that, well, all momentum is strong. The China situation could influence this. We're still looking for a potential up here at this 31.43 level. The highest odds are that it will fail lower than that and we'll get a move down. In about 2 weeks, we expect a best case. This is the best case, is that it moves down to 29.50 to 29.15. This bottom of this is 28.78, something like that. And then this very key level at 27.67. We don't actually expect that to happen until this next cycle out over here. And then we'll actually probably have a higher breakdown level from this pattern. You can see the cycle rhythms, they are beautiful. You can see the momentum pattern, it's all clear. You can see all of this right over here giving you the buy signals. There isn't anything, in my opinion, that could be clearer about the conditions of this market. As it has remained positive, it is in that condition right now. And again, it doesn't turn negative, and there's no warning of it until you get under the VTL coming up here, or you get under this level right over here. That would be your negative warnings for a big top. In the meantime, you're still getting this upward trend, and we're anticipating that it's going to end over here in June because the intermediate patterns are going to be turning down really big. So that's it. You can see, still looking okay. No reason to expect anything really negative in here. If it does happen, you know the numbers it should stop at. And if it goes lower, you know the messages that you're getting from the market. It talks to you. It tells you. And I think that the information, the way we lay it out, really helps you a lot. That is it. All of the important numbers, everything you need to know about the market with the risks picking up as we get into the mid-June time frame. That's it for Market Week. I hope that it was amazing information for you. You learned a ton. Please do become an askSlim subscriber. Don't be shy. Spend a little money and support our team because that's what allows us to keep bringing all of this information every single week. I want you to be so careful. It is so crazy out there. And I'm always wishing you great trading.